Welcome to The Explainer. You know that feeling when you're stuck on a financial treadmill? Paying and paying, but the debt just isn't going anywhere? Well, this explainer is for you. We are going to lay out a clear, no-nonsense guide to finally breaking free from that high-interest debt in 2025.
Get this, the average credit card interest rate, it's sitting at over 20%. I mean, at that level, your debt isn't just there. It's actively growing, almost like it has a life of its own. It really is like that financial treadmill you just can't seem to hop off of. So, if you're just scraping by making those minimum payments every month, you already know this frustrating reality, right? Most of your hard-earned cash, it's not even touching the balance. It's just feeding the interest monster.
Okay, so let's talk about what we're calling the 2025 debt squeeze. First up, we need to understand why consolidating is so incredibly urgent right now.
Look, in today's economy, just waiting around hoping for lower interest rates, that's a huge gamble, a real roll of the dice. The savings you can lock in today by consolidating, that's guaranteed money back in your pocket. Every single day you wait, that crippling compound interest is just digging a deeper hole.
All right, let's dive into finding your financial profile. Because here's the thing, before you can even think about picking a solution, you've got to understand your own financial DNA. This is definitely not a one-size-fits-all kind of problem.
Okay, it really boils down to three key numbers. We're talking about your credit score, your debt-to-income ratio, or DTI, and the total size of your debt. That DTI, by the way, is just the slice of your monthly income that's already going to debt. These three metrics together are basically the map that will point you to the right path.
Think of your credit score as the ultimate gatekeeper. It's the number that decides if a lender will even open the gate for you. But it's more than that. It also dictates the toll you have to pay to get through. It's really simple. The higher your score, the lower your interest rate will be. End of story.
Okay, now this is where it gets really interesting. Just look at the massive difference between having an excellent score versus a fair one. We're talking about a gap that could literally mean paying thousands, maybe over $5,000 more in interest on a $20,000 loan. A great score doesn't just save you a few bucks, it can literally cut your cost of borrowing in half. That's huge.
So now that you know your profile, let's walk through the four main paths to consolidation. Each one of these is a different tool for a different job, and they all have their own unique risk and reward profile.
All right, option one is the personal loan. This is kind of the classic straightforward solution. It's all about streamlining. You take all those messy, high-interest payments and bundle them into one single loan with a fixed rate. That means you get a predictable payment you can count on and you start saving money right away, all without putting any of your assets on the line.
And this right here, this shows you the high-stakes game of the balance transfer card. Don't get me wrong. It can be an amazing tool. You get this incredible window, sometimes up to 21 months of 0% interest to just hammer away at your debt. But, and this is a big but, it's only a win if you beat the clock. The second that intro period ends, any balance that's left over gets slammed with a ridiculously high standard APR.
Which brings us to a really important idea. The lowest rates come with the highest risk. And that perfectly sets up our third option, which is using your home's equity. Yes, this path can unlock incredibly low interest rates, but it absolutely requires you to be brutally honest with yourself about the risk involved.
So here's the bottom line, the crucial point you have to understand. You're not just moving debt around, you are fundamentally changing the nature of the risk. With unsecured debt like credit cards, the absolute worst-case scenario is a trashed credit score. It's bad, for sure, but when you use your home as collateral, the worst-case scenario is foreclosure. Losing your house. It's a trade-off that demands, and I mean demands, a stable income.
Okay, our last option. For anyone out there who feels truly stuck, like you're just drowning in debt, there is a powerful safety net. It's called a nonprofit debt management plan, or a DMP. And it's important to know this is not another loan. Instead, you work with credit counselors who actually go to bat for you, negotiating lower rates with your lenders to create one structured payment that helps you finally get your head above water. Okay, so we've got our four main options on the table. The big question now is which strategy fits you. Let's start matching these tools to the different financial profiles. First up, Profile A. Let's say you have a great credit score. We're talking 720 or higher, and a relatively small amount of debt, maybe between $5,000 and $10,000. For you, the balance transfer card is almost a no-brainer. It's your most powerful, lowest-cost tool, if you're disciplined enough to pay it off before that 0% intro period expires. Next, Profile B. Maybe your credit is still pretty good.
over 690, but you're dealing with a much larger chunk of debt, say $20,000 to $40,000. In this case, the unsecured personal loan is likely your best bet. It strikes the perfect balance between getting a good, fixed rate for real savings and the security of not putting your house on the line. That peace of mind is priceless.
Now, for Profile C, this is for the homeowner with excellent credit, like 750 plus, who's tackling a huge amount of debt, $50,000 or more. Here, a home equity line of credit, or a HELOC, can unlock the absolute lowest interest rates possible. And here's a little pro tip for right now. Its variable rate could actually work in your favor. With the Fed expected to cut rates, your payment could actually go down in the future. And finally, Profile D. This is for anyone with fair or bad credit who just feels completely overwhelmed. If traditional loans are off the table, a nonprofit debt management plan is the most responsible and, frankly, the most effective way forward. It's a path designed for recovery, not to trap you in another high-interest loan. All right, we've matched the tool to the profile, but let's be real. Consolidation is just step one. The real goal here is winning the long game. So, how do you make sure this change actually sticks? This right here might be the most important part of this whole explainer. Consolidation is a tool. It is not a cure for your financial habits. The number one risk, the biggest trap you can fall into, is going right back and racking up new debt on those credit cards that are now magically empty. You've been handed a clean slate, and it's on you to protect it. So how do you do that? You have to create a barrier between you and new debt. That means immediately freezing those old credit card accounts, or even better, just closing them entirely. Then you shift all your focus to making perfect, on-time payments for your new loan. And this is key, you build a budget to finally address the spending habits that got you here.
And if you do all that, here is the long-term payoff. By converting that revolving credit card debt into a fixed installment loan, you are actively healing your credit health. You'll slash your credit utilization rate, which is one of the biggest factors in your score, and as that score climbs, it opens up doors to way better rates on things you actually want, like a car loan or a mortgage. So at the end of the day, consolidation is the tool. It's what gives you that crucial financial breathing room. It's a chance to not just get out of debt, but to start building the future you actually want. The only question left is, what are you going to build with it?